Good afternoon and good evening. On August 15th, the market has closed. It was a good week of investing overall. It was a positive week for my portfolio, and I hope it was a real positive week for yours. We had some stocks that became really interesting. I wanted to live stream because I just wanted to talk about some stocks that are really beginning to form an upward trend, which should be interesting to watch. So I'm going to talk about some stocks that are becoming really interesting. I'm also going to talk about some stocks that have been performing for quite a while and just talk through those, kind of wrap up the week. And if you'd like for me to talk about a stock, I'd be happy to. I'd prefer to talk about stocks you want to talk about. And if you're a member of the channel, please put it in the chat. If you're not and would like me to do so, a $5 super chat, and we're off to the races. Now, we don't just talk about stocks. We analyze them. We review them. We look at the qualitative factors of a company. Do they have a strong moat? Can they keep competitors out so they can grow their top line revenue? They can grow their cash flow. They can grow their profits. If they do, that's very good and becomes a valuable business. The other question we need to ask is, would I be getting a good price? Because it's good to buy quality stocks, but buying them at the right time is the difference between making a lot of money and not making a lot of money. So trying to find stocks that are priced at a discount is ideal on really good companies, companies that we believe in, or companies that we think are going to really bounce back, maybe have had a rough time for a year or two, but are going to make a good comeback. And I'm receiving a terrific discount. So if they do make it back, there's a windfall of profits when it comes to an investment like that. Those are recipes for success. I'm a long-term investor that loves either finding great businesses that are just going to grow rapidly, or maybe a bounce back story of a quality business or a business that is worth quite a bit and it's just been sold off by the market. Either one will do. The money spends the same, whether I buy a stock like Nvidia and make money, or I buy a no-name stock that triples my capital. The money spends the same. So I'm good with either one. So let's get into it. Let's review the market. Let's see what it's done. And please fill in that chat. Looks like we've got more and more people joining the live stream. Thanks so much for joining. I appreciate it. So this week, I'm looking at the 1 week heat map. This collects all the data for the prior week. Looks like Amazon had a terrific week, up 3.5%. We had Uber up 3.39%. Adobe had a good week, up 4%. Meta up 2%. Netflix up 4.76%. Berkshire had a pretty good week. Qualcomm had a terrific week, up 7%. We go into healthcare. It is very good to see some green there. Boy, healthcare has not been doing well for months, and it's been really a place where a lot of stocks have been sold off. And United Healthcare, boy, had a terrific week, and it had a terrific 24 hours. I will talk about United Healthcare in a little bit. Aside from United Healthcare, CVS had a good week. Elevance had a good week. Eli Lilly had a terrific week, up 12%. We had just a lot of green out there in the healthcare sector. Very good. Looks like communication services also had a terrific week. Look at that. Real green. And consumer discretionary, Amazon being the biggest cap, it had a really good week. So some good stuff happening. Materials also had a good week. Very good. Very good. What didn't have a good week? Consumer staples had a setback. Looks like Walmart sold off. Interesting. Cisco had a bad week. Applied Materials, terrible week, down 12.5%. We had Palantir sell off a little bit. But that's just been a terrific stock overall. So no big deal. Fortinet had a good week. Palo Alto had a good week. Looks like Shadow Guy is on. When you think about it, UNH is like Benjamin Graham's spec. You got that right. That is a value investor special right there, is UNH. Good to see you, Shadow Guy. Looks at Brucey. So Bonesupport holding AB. And is AB a stock, sir? So let me see if AB is a stock. And good to see you, Brucey. Alliance Bernstein. Maybe I'm not following your comment clearly. Please let me know if this is something you want to look at. I think this is like it's an investment manager. So this is like I guess like a BlackRock, lesser known one. All right. So this is what happened. We had some earnings this week. Bonex. Okay. Got it. We can look at Bonex in a bit. Good to see you. We had a few earnings this week that were kind of, came here or there, and didn't really move the market a whole lot. I think it just, had some businesses report. Cisco reported and they really sold off as an example. Applied Materials sold off as another example. So that was interesting. What happened yesterday on the 14th, a lot of 13F filings were issued out. 13F filings are where these big institutional investors have to report to the SEC and state what they own, what they sold, what they bought, and pretty much share what their portfolios look like. And there was a lot of news around United Healthcare and what they were buying and selling. So it'd be interesting to look at some stocks that really moved on that news. All right. So one of the stocks that I wanted to get rolling with is going to be Transmetics. So Transmetics came out in the live stream, and it may have been, was it you, Bushy, or somebody else came up with CRMD, and it came up twice. Came up on an investor call on Sunday, and it came up on the live stream. We analyzed it, looked at it multiple times. I ended up buying into the stock this week, and it was you, exactly. So this stock is really been climbing. It's a healthcare stock, biopharma stock, and it's really been performing well for the 1 year. Even the 5 year had some some severe volatility in its first year of being a public company, and really over the last couple of years, it's really performed nicely. Well, this stock is a small cap. It's still under $1 billion. So it's still relatively small. It's not too big. And you're paying about 8 times revenue. And PE looks pretty rational. The forward PE looks really affordable, really low. Analysts think it's discounted. When we analyzed this, it looked like a well-priced company that you can buy. You're getting it at a discount. And if they do better than what we're seeing from the forecast that we put together, this could just continue to go up. Some of these companies, they have a very high ceiling for a couple of reasons. The small cap, they have a very small cap, so they can just keep going up. And they're part of, a very large addressable market. Healthcare, if these guys are helping people with illnesses, conditions they have, and their medication or treatment works, boy, their product's going to sell big time. It's going to be recommended by doctors. Doctors are going to be eager to get their patients to use this treatment. So this is a pretty exciting little company that's supposed to grow. In 2025, they're going to be about $164 million in revenue, and they're going to go up to $281 million in a couple of years. If they overachieve on that number, look out. This is really going to be an interesting stock. So I was glad to pick up some shares of this stock. Just a couple. I'm a dollar cost average guy. Over the 5 days, this is up 25%. Man, I just had to, just get into the stock. I didn't mess around with this one because I hate when I try to get too fancy with it, and then I'm sitting there a month later without buying a stock while it goes up. So I just kind of forced my way in and bought some shares, and it's been a good good things so far. I think did it have a good day today? It did have a good day today. It's been having a lot of good days. And year to date, it's up 59.6%. So this was a really good suggestion by a viewer of the live stream who is now a member of the channel. And it was a good stock that we talked about on the member call. So this is really fun to find these small caps that are really working and have a lot of upside potential. And this is real potential where the profits of this company are really high. If you look at their gross margins, this one has gross margins of 95.6. That's really high. That means they drive a lot of that revenue and they turn it into profit and cash flow. So really excited about this business. I'm going to be watching it and see how I can get more shares over the next month or two. So Transmetics, a real nice stock for the week. Now, going a little bigger in the same industry, United Health, terrific week, up 21%. The news that Warren Buffett, along with Michael Burry and some other investors, a total of 19 super institutional investors have bought into United Healthcare collectively, all of them together. Some of them already owned it, but now we have Warren Buffett, arguably the most famous investor of them all, going into United Healthcare. And this is a stock that is really tailor-made for Warren Buffett. He likes businesses that are have a lot of long-term value, that are really sold off, and he's getting a terrific price on. So he got a great bargain on United Health and he took it. He bought somewhere around $300 a share, and he drove the price 12% from the time it was announced. So now he's probably sitting in the green just by a little bit. And I've been collecting United Health shares for a while, and glad that I did so. And I will be glad to buy additional shares. I think this stock's going to go to $600 per share. I think they have the fundamentals most definitely to get to 500, but I think the market is going to go past that $500 mark. The reason for it is this thing's so beaten down. When you look at how sold off it was at $600. It was at $600 in 2025, and it sold off just drastically. Incredible. While the business continues to grow revenues. So you see this revenue growth. You know, what's wrong with that picture? Why is the stock price crashing so hard when these guys are a gigantic business growing at 10%? That just is irrational. So I'm glad that I was buying into United Healthcare and just going contrary to all the naysayers, all the fear. Everybody was fearful, and I just continue to collect shares. This was a gratifying moment to see that United Healthcare was being accumulated by other, or I should say, super investors, and that the market really recognized it today. I think this stock here most definitely is got everybody's attention and is going to receive more capital, more inflows. And they have a terrific business. Look at this PE 13. You know, finding a PE of 13 is hard. And you're finding it in a business that's growing, that has a very established business, number one in their business. There's no other company that is larger than them in the health insurance business. So looks terrific. And the stock's down so much, you get about a 3% dividend. Historically, United Health would pay like a 1% dividend, maybe 1.25. But now the stock price is down so much, you can lock in about a 3% dividend yield, which is terrific. So we'll see how, you know, United Healthcare trades, but I think it's the dawn of a new trading era for United Health. Over the last month, it's close to even. Year to date, it's still down substantially, but you can see this beginning to rally. And it's not about where the stock's been, it's where it's going. These guys have the fundamentals to really keep this stock going up. Really, really happy. I've got United Healthcare. I've got the insight. I've got the knowledge, and I'm ready to go. It's a stock that I felt for a couple of months that, you know, I was going to stick to my guns and continue to believe in United Health. And I still believe in them. And I'm glad that I was able to share at least what I was seeing with my investing community, my immediate community, And now we had a good day together. Really cool to see United Health. So that was a really, really nice moment. Carlos, good to see you. I am still adding United Healthcare. Absolutely. So I owned United Health up until 2022, 2023. And I owned a pretty good investment of United Health. And I really enjoyed the stock. I mean, you look at the stock, this is what the stock did. It was a great stock. And then it got to kind of a consolidation period, a plateau period, and then it had all these troubles. But the business, again, I look at the business is not broken. The business is a very viable business. We need health insurance. United Health is not going anywhere. So I was glad to pick up the shares and say, hey, you know what? I made a lot of money on United Health before. I would be happy to make a lot of money on United Health again. I have a good position on them, but I'm going to throw a lot of capital into United Health. I'm going to accelerate my buying into United Health because I think from this moment forward, I'm very, very bullish on the stock. So United Healthcare was released. Awesome. All right. Before I move on to the next stock that was really on my list, let's take a look at what a member wanted me to look at, which was Bonex. Got it. Okay. So now it's all coming together. So it's a Swedish, it's on the Swedish exchange. Okay. And this is an orthobiologics company, develops and sells injectable bioceramic bone graft substitutes in Europe, North America, and internationally. The company provides Cerament bone void filler, an injectable ceramic bone graft substitute that remodels to host bone. Cerament. Okay. So people need this for reconstructive surgery. Got it. I totally get that. Founded in 1999, so it's about 26 years old. 139 employees. The stock year to date is down. Over the 1 year, it's really flat. And over the 5 year, it's up 499%. So it's had a pullback after just having a terrific rise. 18.5 billion. So this is a pretty good market cap. Now, I want to see, this is in the SEK. So just so that I kind of have a sense of how big they are, I'm going to look at SEK to US dollar. So about 10 to 1. $1 will buy you 10 Swedish krona. Okay. So if this market cap is in the Swedish currency, this is going to be about a $1.8 billion market cap. Revenue is about 106 million per year. Okay. PE ratio is a little high, 127. Forward PE is 61. Okay. Revenue looks real good. And this is in the Swedish krona. So this is going to be about 1/10. The good news is it's an easy number to kind of just quickly do the exchange rate in our minds. It's about $106 million in revenue in USD. 44% growth. Awesome. That looks really good. Cost of revenue is very low. You see how it's just a fraction. Gross margin is 92.59. So these guys probably own the intellectual property, the patent on what they created here. And they probably have some manufacturing partner that is producing the actual product, packaging the product, and then delivering it or shipping it to the doctor or the surgeons or whoever is going to be using this product. That's what keeps their gross margins so darn high. They're, in essence, they created the science, and then they're having some other company, a vendor, do the manufacturing. It's very lucrative because they can grow quickly this way. They have a manufacturing partner, and looks good. When we look at free cash flow, they do about 20%. This is going to be about $21 million. The good news is they are cash positive. How long have they been producing revenue? They have been producing revenue for a while. So they've been building this business and now are, growing the business quite well. At 44% growth rate, they will double every 2 years. It'll be a very quick, revenue growth for them at this rate. All right. So 21 million. And I'll do a valuation on this one. We're not going to get any analyst reviews of it. Let me take a peek at their balance sheet. Make sure they don't have a lot of debt, because debt is bad. They have literally no debt. 12 million. And this is 12 million. We're still in the same currency. Sometimes this website will do the translation. It hasn't done that. That's fine. So this is very little debt. They have some cash. Very good. All right. So let's roll up our sleeves and see what this business is worth. We're going to value it on a couple of factors. We're going to value it on the value of today, net present value of their cash flows. We're going to see per share, what is the cash flow we expect from this business worth today? And then we're also going to look at earnings per share and say, what is the earnings per share value? Earnings per share valuations are probably the most popular on Wall Street, but a lot of the highly respected investors don't use it. They don't like earnings per share because it could be manipulated, influenced by management of that company. They can do the accounting in a way that makes that earnings per share number look a little too good, or maybe not completely transparent. Free cash flows is far more transparent. Cash is cash. It's very hard to disguise your financials. And so that's why, like, a lot of investors, they don't touch earnings per share. They just go after cash flow. I do both. And I use the free cash flow method as a greater weight, but I like looking at earnings per share. I think it gives me a different lens to that company. And it is the most popular way that companies get priced. And it's a way that the market sets prices on stocks. So it's good to know. All right. So let's get cracking. Let's get to work here. Let's do a valuation. I'm going to open a screen that you guys cannot see so that I can look at some numbers. And then we'll start. We will get to work. All right. So this is a pharmaceutical biotech company. I got plenty of those that I analyze. So let's go into a stock that is similar to this company. I'm going to go with United Therapeutics. Now, I'm not going to, since the person asking this question, I know he is in Europe. I think he is in Sweden, or he's either in Sweden or Norway. I forgot. I'm going to keep the discount rate at 9% and just make the assumption that, hey, somebody in Europe should be able to know how the economy is looking in Sweden. And so that'll be fine. Okay, so let's get this a little better. Bear with me. I'm just kind of making some space here to be able to then copy this template. Man, I created a lot of space. Okay, so I'm going to take this and copy it, and it'll be kind of our starter template. I use Google Finance in a lot of these lookups, it may not like to look up this particular ticker because it's in another exchange, but we will soon find out. Hey, I looked it up. Nice job, Google. Very nice job. So Bonesupport Holding. All right, today's date is the 15th. Okay, so we're going to keep this in the currency that it's being reported in. So I just wanted to put the currency little note here just so anytime we look at this, we know the currency is the Swedish krona. And the trailing 12 months. Now let's take a look at this together because this is going to be a judgment call. So this is a growing business, and we have the company just started to cash flow. So I'm going to go into quarterly so I can kind of see how these quarters are looking. And that'll help me to say, what should I grow these cash flows by? So you see that we were actually several quarters in the past were positive, one negative, and then we've gotten into consistent positive cash flow. Okay. And the trailing 12 months was 210 Swedish krona. So that's a pretty solid number. That looks good. And I'm going to grow it. They're growing their top line revenue by 44%. So I'm going to grow years 1 and 2 by 40%. And then I'm going to grow years 2 and 3 by 30%. Because by the time they get to year 3, they're larger and the growth is probably not going to be as high looking at it in a percentage method. So I'm going to put another category up here. This is going to be growth for year 1 and 2. And then this is going to be growth for year 3 and 4. With really young businesses, I'd rather do this so we can really match growth rates that we think are going to be realistic. And then we're going to go with 40% here. 40% would probably be too optimistic to keep it across the board. So I'm going to leave it at 40% and then 30%. I think that's going to be doable for them. It's a small business, so they're going to have a very long runway of growing. So I'm going to grow their long-term growth by 5%. All right, we got that in order. Now what I'm going to do is I'm going to put the 210 trailing 12-month number. We're going to multiply that times 1.4, representing a 40% growth rate. And then this guy, instead of going to sell K805, we're going to go to K804, which would grow it for 40%. Very good. This one's going to go to this 30% growth rate. Okay. So we're kind of stair-stepping this, right? Not stair-stepping it, but just adjusting the growth rate more realistically to what should happen. All right. So we're driving intrinsic value up to 13.39 billion Swedish krona. Now let's add the cash flow that we had on the balance sheet and see what we're ending up with. So the cash flow was 309. And a little bit of debt, 12.68. Now let's take a look at shares outstanding. Shares outstanding were 65.86. With the market cap of 18.59. So we're getting a 26% premium. The cash flows that I'm seeing them produce, let me update my notes. So trailing 12 months, then I'm growing it. I'm growing it by 40%. So that's a pretty good jump in cash flow. And then I'm growing it by 30%, another substantial jump in cash flow. But even after I do that, I'm falling short of the valuation. So that's what the numbers are telling us. Now let's get to earnings per share. What is the trailing 12 months earnings per share? We're at $2.25 per, and that's $2.25. And again, we're dealing with this currency. Make that a little bigger so it reminds me. This is a good growth company. It's growing really nice. So I'm going to give them a 24. And I expect that they're going to grow this earnings per share by that amount. So 222. Yeah. Right now, they're trading at a PE of 127. Man, I hate paying super high PEs. I cannot go past 36. This is a small business. I love their margins, okay? Love their margins. But it's a small business. What if, example, big giant pharma company, Eli Lilly, or name the company, said, hey, we can do that too, and they start competing against this little business. That bigger business can use their network power and really create problems for this company. So this stock is priced too high. And when we look at the historical, where the chart on the historical, you see the stock really went up. And sometimes stocks go up when they're not really reporting their profitability. And everybody just expects, oh, they're going to be gigantic and really profitable and so forth. Then once they start reporting their actuals, you see how this stock's really faded. Well, maybe other analysts and other investors are getting to the numbers and saying, whoa, this one's overpriced, and they're selling their stock. Maybe. I'm getting to a conclusion that the stock's overpriced. I could find other stocks in this industry that show really good discounts that have this type of growth. So it's not like a unique company. This is the only one that's growing. Nope. I can find you a lot of them. I do think it's unique that they're that profitable, but that's where my numbers land. And this would not be an investment that I would make. Not sure how you feel about it. Would love to hear your comments. Let's see here. Man, you guys are bringing it today. Thanks so much. We got a super chat. Thank you so much. So this is Amandio Marquez. I am on it, sir. Give me 1 minute. I just want to finish off with Rushi. So yeah, I got to these numbers, and I mean, this is the cash flow, right? Even let's say we said, you know what, they're going to do even better. They're still priced too high. Well, I don't want to get in the habit of giving companies 100 PEs. It's just, what are we doing? I can buy Facebook for a PE in the 20s. Facebook's growing at Meta. Meta's growing at 25%. They got like the world in the palm of their hands. They have 3.4 billion people accessing Meta. I could give you a list of 20 stocks. I'm paying PEs in the 20s or 30s. And I know those businesses are going to be awesome. So this business, are they going to be awesome? Maybe. But if I have to use the word maybe, they are not going past 36 for me. And am I going to expand their cash flows by 50%? No. Why? What if the manufacturing partner says, you know what, it costs more to produce your product. So I'm going to increase your prices. So then their cash flow goes down. Or many other things can come up. It's business. Things are going to come up. So this one here, it's not going to do it for me. And I'm going to hold this in my file of research because I know that I'm going to post probably this weekend an update. And then Bushi, if you want to look at it, you can look at it. You could just search it up. You just go control, find, you look for this symbol. It's going to take you there and you'll be off to the races. So I'm going to keep it there maybe for a month or two and then eventually delete it because unless all of a sudden things change, what if the stock price gets attractive? Well, then I would be more attracted to it. So I'll keep it around for you and you can look it up. I'll try to update it this weekend. All right. We got multiple super chats going. I've got my work cut out. I'm going to look at Accenture. I'm very familiar with Accenture. And we're going to look at Regeneron. I am familiar with Regeneron. And then we're going to look at TMDX. Sam Fowler, thank you for coming. Thank you for sponsoring these super chats. Really appreciate it. Let me say hello to everybody. And then we're going to get cracking on Accenture. So, Santario, very good to see you. Thanks for joining. Carlos, I already said hi, and I want to say hi again. Shadow Guy. Not a recommendation, but if you want a bad one, LON.Wiz Airlines. So I guess it's like a company that's struggling. We can take a peek at it. See what it's all about. And then Mike, the dividend investor guy. I did have family time. I went and visited my 89-year-old mom this morning. Took her out. She went grocery shopping. We had a lot of laughs. Got some things done around her house. Spent 3 quality hours with her and then made my way back home. I thought I had something going on with my sons and the plan changed. Now, the week's been super interesting and I wanted to just stream because frankly, I love investing and this week in particular was super interesting to me. So I just wanted to stream. It was unplanned, but here I am. Thanks for asking, Mike. And that's where I'm at. All right. So Sam, thanks so much for the super chat. And Mike, which one did you want to see? Did I miss a ticker that you wanted to look at, Mike? So you got Okay, we're good. All right, perfect. So let's get into Accenture. So Accenture is a professional services company. They do a lot of professional services, mainly around technology. So when you think about consulting, they do technology, operation services. It's an American company. It actually came out of, if you guys knew of Arthur Andersen, the big accounting firm. Now they don't exist anymore because they unfortunately co-signed the fraud that Enron was committing on the stock market. And you can't do that as a public accountant. It's one strike and you're out situation. So they were found guilty of signing off on financials fraudulently. So Accenture was basically killed off. They started what is now Accenture, and it used to be called Arthur Andersen Consulting or something, but they rebranded as Accenture. I've known of this business for a long, long time. A long time ago, I was like 22, and somebody that I got to know, he was 20 years my elder. He was an employee here. He was an early employee, so I got to know him way back when. So these guys do professional services. Their stock has been working long-term. No, it hasn't. I thought it was. I guess I haven't looked at Accenture in a long time. It's been a while. A long time ago, this stock's been doing well. Now, before I dig in here, let me kind of qualify what I'm going to share. Accenture is in the industry that I've worked in for 30 years. I know this industry really, really well. And high level, I don't like investing in businesses like Accenture because they don't control like a piece of technology, a software. And the reason for it is, for example, um, if you're a software producer, let's say a Palantir, you wrote the software once, you sell it to 10 million customers. You wrote it once, and the profitability on every incremental unit is super valuable, is super profitable. Accenture is in the professional services business. If every customer you get, every transaction you make, you have to put a human resource behind it. It's not like the consulting magically happens. No, they're hiring people. When you look at the margins of Accenture, they're not going to be like NVIDIA. They're not going to be like Palantir. They're not going to be like that. Little J, good to see you. You want to look at AMAT, applied material. We can definitely look at that. So let's crack Accenture open and see what we got. Market cap 154 billion, revenue 68 billion. PE 19.66, forward P is 18.4. Analysts think it's really discounted. All right, so they've been growing single digit, but they are a pretty big business, $68 billion in revenues. And the thing that I would say looks good is 2018, there were 41 billion. Now there's 68 billion. So they have been getting bigger and bigger and bigger. That looks good. Their growth hasn't been, really fast lately, but it's positive. So that's good. So here's where there's a difference between Accenture and let's call it Microsoft. Gross margins 32. Remember that comment I made on professional services, not as lucrative, not as profitable as Microsoft or even a Google. Businesses that these guys, Accenture, they do consulting to businesses that want to expand their use of Google products and cloud services, as well as Microsoft and other companies. Even CRM, Salesforce had a really good day. Salesforce, their margins are like 70%, and that's a software business. See how more profitable that business is. Same ecosystem. They're both kind of in the same line of business, so to speak, but one business is just more desirable than the other. Moving on, their cash flow, it has expanded nicely from 5.4 to 10.2. $10.2 billion of free cash flow, growing mid-single digit. Okay. This is a quality company, by the way. Very highly respected, very good firm. Now, high level, I would say this business to me is going to be worth about 200 billion minus debt. Let's see if they have any debt. They really don't have any debt. They have $9.64 billion of cash, 8.17 of debt. So they have more cash than debt. So you could say that, hey, these guys are worth about 200 billion. They're priced right now at 154. The market's kind of done this. All right. So let's do a valuation on this. And we're going to get to more precise numbers. Now, what kind of investment is this? How desirable is it, right? And I'm going to open up a spreadsheet here that I can get my point across clearly on it. You've probably seen my videos and you've seen this quadrant that I've created. So I'm going to park their logo down here temporarily, and we're going to go through a scorecard. Accenture, they do professional services. Now, are they the only ones on earth that can do professional services? No, they have competition. They have Deloitte. They have uh, a number of companies out of India that do consulting. They have all the accounting firms have consulting teams. Price Waterhouse, PwC. You have Ernst and Young. You have all kinds of competition. But I would say these guys, they probably have the best brand. Even IBM has professional services. But Accenture, I believe, has this is kind of like the Mercedes-Benz or the Toyota of the industry. Very good brand. So I'm going to give them a B plus, but not an A. Why? They still have to compete against others. Their network power, I'll give them that. I'm going to give them a B plus. They do have network power. They have relationships that they're going to extend. Balance sheet looks good. Revenue growth, a B. Solid B. You know, they're big. They're growing. Profitability, C plus. They're never going to be an A student. It's just not in the cards. They can't handle the hard math or something. Free cash flow, looks good. I'm going to leave it as an A. But you can see that they're not an A student. A students are here. This is an A student. This is a Palantir. This is a NVIDIA. This is a Microsoft. So these guys, they don't have the growth to be on this side of the quadrant because the way that I place companies is the strength of their moat. A moat would be like Meta. Nobody can compete with them. Nobody has the scale like they do, the network power and so forth. So Meta's kind of in its own league, strong moat, and they're growing their cash and they're growing their profit. So they would be a combination, and Meta would be way up here. Amazon would be way up here. Okay. I'll put that up there as an example. Accenture, they're not going to be on this side because they're not growing fast enough. But I believe that they have a pretty strong brand, network power, and balance sheet. Okay. Their profitability is never going to be, like Zscaler or NVIDIA, which has 85% gross margins. Now, businesses that are in the gray, this type of company, I'll be an investor if you offer me a very compelling discount. For example, United Healthcare, I sensed that we were getting like a 55% discount, extremely high discount. Give me some United Healthcare shares. I will buy them all day long. So let's see what kind of discount we're going to get on Accenture and see if it's compelling. All right, back to this model. Let's get back to work. So Accenture is professional services. Now, I'm not a big professional services investor, I must admit, but I'm going to park these guys right next to Microsoft. That is not a bad neighborhood to reside in. Microsoft is the second most valuable company on the stock exchange. An excellent business, a business that's going to be around for a long time. And I'm sure Accenture provides a lot of services to help businesses implement Microsoft, do more with Microsoft Azure, optimize their technology investments. Accenture is probably all over helping businesses figure out how they're going to use AI. All that kind of stuff is probably what's keeping Accenture busy and having their consultants go out on site and they bill them at a really good rate. Businesses appreciate their help and so forth. All right. So I'm going to open up Accenture, this on another screen. You guys can't see it, but it's just so that I could do some data entry and you guys could follow along on this particular template. So we've got Accenture. Accenture's solid balance sheet, 8% is fine. We have trailing 12 months cash flow. That looked really good. It was 10 point something million. 10.244 million. So we're going to go with 10.244. They were growing single digit very nicely, and they've been growing their cash flow really nicely. For example, over the last year and a half, they've grown it by about 14, 15%. So I'm going to grow it by 7%. And we'll put 7% up here. And FYI, for the members out there, you get a copy of this model. So you could start creating your own valuations and putting numbers in here and going through the thought process. All right. Long-term growth. 4.5. I'm not sold on 4.5. We're going to go to 4. I had given Microsoft a 4.5, but not in this case. So right here, these numbers are going to grow by 7%, and the terminal value is going to grow by 4. Okay, so we're up to $277 billion of value on these cash flows. Looks good. So we had more cash than debt. And how much cash did we have? We have $9,640 million in cash, and they had $8,170 million of debt. Shares outstanding. I use these lookups, but sometimes they're not right. I would badmouth Google, but I'm a shareholder. I shouldn't do that. I should see this one is wrong. Come on, Google. Get it right. Again, I'm a shareholder. I got to watch what I say. Shareholder of Google Alphabet. But it is nice that they provide all these lookups, by the way, for free. I should mention that. All right. So this thing is discounted based on those cash flows. And did these guys pay a dividend? Let's take a peek here. They do pay a dividend, 2.4%. This is a good looking stock for an investor that likes income, wants to buy stability. Accenture is solid. It is solid. That's a pretty good looking discount. That's a pretty good looking discount on cash. Let's take a look at earnings per share. Analysts said it was 44.29% discounted. I'm at 45 on cash flows. Okay, we've got 20 analysts. And let me do this in front of you so you kind of follow my logic. We have 20 analysts covering the stock. The analyst with the most optimistic outlook has a price target of $420 per share. The analyst that's the least optimistic, $240. Downside risk is really low. Looks pretty good. Looks pretty good. So these guys have a year that ends August 31st. So it's going to end this month. I'm going to go ahead and go to next year because I like looking at everything's looking forward 12 months. And if I look forward 12 months, we're really looking more into this fiscal year. This fiscal year is expected to produce $13.93 per share. It's expanding by 7%, and it's going to expand by 8% and then 12%. Revenues are going to keep growing single digit and then have a higher growth rate in a couple of years. So I'm going to go with 13.93, and I'm going to grow these by 7%. All right. So let me pop that in there. $13.93. P of 25 is fine. This is a quality business growing. We're going to grow by 7%. So this gives us a nice discount. So this is a discounted company. What kind of, just, thinking of, there's all kinds of different investors, right? You have older investors that are like trying to preserve their net worth, preserve their capital, and want to see good rates of appreciation without too much risk. And they like seeing income. This stock gives you 2.4% dividend. It has seen a sell-off in this space, right? 1 year, it's down 24%. So it's sold off while the company kept growing. Okay. So that's kind of okay, what's going on here? The business got bigger. That makes it more valuable. They were profitable. Okay, good. They generated free cash flow. That's good. They grew cash flow. That's good. Well, what gives? Why is the stock price being lowered? It should be going up in proportion to how the business is performing. That's logic. That's my logic. Over the 5 year, it hasn't done much. Okay. This one's probably not going to double in value in the next 3 years. It may double in the next 5, frankly. But I like this stock. It's going to be a good appreciator. You're buying it at a really good price at a really good time. One big high level positive. We're seeing businesses really begin to try to implement AI into their businesses. Let's put agentic AI agents that are going to do particular tasks for a business. As simple as replying to an email, and that email has, it's written in a way where somebody might even think it's a human that replied. It could be businesses are writing code with AI. I mean, there's a lot of use cases that are being proven out. Accenture has the expert consultants that could help a business see where they can do AI and help them build it and charge them to help them build it. But there's good ROI for those businesses if they figure out how to do certain jobs that, let's face it, they had to pay somebody a salary, benefits and everything. But these guys help them to automate it, optimize it. So I like the big picture for Accenture. I think the world is getting more dependent on technology. I don't need to convince anybody of that, right? And these guys are right in the heart of it. They're the ones that help businesses make that happen. So I think their business is going to continue to grow. This stock's discounted. You're buying it at a discount. Again, if I have sons that are 21 now, he turned 21 on the 10th of August, and then I've got a 25-year-old. I would not recommend this stock for either of their portfolios. I'd be like, no, you need to bet on something that's going to go 20x, 30x. Try to learn how to find businesses that are just going to be incredibly valuable. Go find the next Palantir. Go find the next NVIDIA. Go find the next Meta when it was little. Accenture is a good one for, I have friends that are my age. I'm 56. Hey, Accenture is a good stock, real good stock. You can depend on it. I don't think it's going to fall. The price is going to go down any much further. And I think it's going to have that dividend. So thanks for bringing it up. It'd been a long time since I've looked at Accenture. I've never been an investor. I haven't liked professional services companies. I'd rather buy Microsoft. I'd rather buy Google. I think they're going to have, let's compare Accenture. I mean, where this is going to lead, but let's do it anyway. So obviously you wanted to be in Microsoft over the last year, and you definitely want to be in Microsoft over the last 5 years, right? This is why you want to be with the company that has the higher margins, higher profitability, the higher rate of growth on cash flow, the control of that IP, the IP being when Microsoft, like I'm running a PC here, every time a PC is sold, they pay Microsoft for Windows. It's almost like a tax on every single PC that's sold on the planet. Microsoft gets a piece of it. And they don't have to do very much. They wrote the Windows code once, and now 1 billion computers use it. That's really profitable. That's the business I'd rather have. But if you were interested in Accenture, I think it's a good investment at this time. So I really dug deep on that one, kind of went in a variety of kind of directions. I hope you found that interesting. Thanks so much for asking. Let's get to your next stock. So the next stock we're going to look at is Regeneron. And that was Amandio Marquez. Great to have you. You paid in euros, I think. So coming in from Europe. Awesome. All right, Regeneron. Regeneron is a pharmaceutical company. Excuse me. Got to take a sip of water. It's been a nice warm day in California. And all right, so along with a lot of pharmaceutical companies, Regeneron sold off for the last year. But boy, if I looked at 20 pharmaceutical companies, I maybe could find 2 or 3 that have gone up. Healthcare is just really taking it. Today had a good day. This one sold off. Over the 1 year, holy smokes, 50%. Whew. But, again, just real quick diversion. You think that's bad? You got to look at NVO. Holy smokes. Didn't mean to scare you there, but here we are. Regeneron down 50%. What's going on? Are revenues collapsing? Is this business in trouble? Why are they hurting so bad? Over the 5-year, these guys were cranking. Look at this appreciation. Investors were so happy, and then all of a sudden, this thing came off a cliff and is down 50%. All right. Market cap, 60 billion. Revenue, 14.21. What do these guys do? They're pharma. They do discover, invent, develop, commercialize medicines for treatment of various diseases. I knew that. We kind of know what they do. They're a pharma company. Biotech, pharma. Okay. So we are at $14.21 billion of revenue. And analysts think it's discounted by 39%. So this is what is upside down right now with healthcare. Is you have these businesses that have a pretty large business that keep growing. In 2023, these guys grew by 7.76%. Then they grew by 8.27%. This year, they're growing, I should say, trailing 12 months, they're growing by 5%. That's because they had a contraction in their fiscal first quarter, which ended March 31st. So a little bit of a hiccup there, and it kind of fell back. Now, that's interesting. That happened about 6 months ago. And when we look at their stock, is that when we started to see that decline? Let's take a peek. So 6 months ago was around here. Now, they were already starting a decline. So they started their decline around August of last year. So about 1 year ago is when they went sky high, and then they started to come down. Well, let's take a peek. Let's get our forensic accounting hat on and see. Let's follow these quarters. What happened a year ago? So we're at June 30th. So this is what got announced. About a year ago, this was announced. And they grew by 12.3%. And they kept growing. So I'm not finding kind of like the smoking gun here. They were growing quite nicely, and the market started to sell them off. I guess the market did see that they were going to slow down. And maybe that's why the market repriced them and said, you're not a 10% grower. You're going to be a very slow grower or no grower. Like Pfizer's a no grower right now. And these guys are kind of in that no growth state. When do they announce? August 1st. They just announced. So we got data that's about 2 weeks old. Looks good. Okay, so this is going to be a slow grow, no grow situation. Let's take a look at their other fundamentals. Gross margins are lower than I would have expected, by the way. Pharma could be 85% margins. These guys might put more labor into each particular unit they're selling. So that's why their margins are not as good. I could show you Pfizer and it's much higher. I could show you Novo Nordisk is at 85%. I mean, beautiful. So these guys are at 50% margins. Their business isn't growing. Cash flows flat. And actually they've been contracting. See, we're going from 6.5. We're going down. That's not good. That's not good. Look at this graph. This is not a pretty graph. This is a not pretty graph. Doesn't have any trajectory, doesn't have a trend, especially an upward trend. It's like, okay, what's it going to do next? I don't know. It looks like it's going to be flat. It's going to be around high 3 billions. So this stock, this company doesn't have a lot of momentum. And they have trading 12 months, 3.8 billion. They don't have a lot of growth. So I feel like these guys are worth about 60 billion minus debt. Let's see if they have any debt. So they have more cash than debt. They actually have a surplus of about 5 billion of cash. So they're worth about 65 billion dollars. And they're priced at $60 billion. This is a fairly priced stock. They don't pay a high dividend. I'm not seeing enough for me to be interested. And the reason for it is within this industry, I could show you 5 stocks that look really interesting. So I could quickly, I'm going to do a quick valuation. Then I'm going to show you a couple of stocks that are in this particular area, this sector and industry that actually do look pretty darn good. So let's go. Let's crank through this and get the job done. All right. So I'm going to open up my other screen so we can kind of crank through it. I haven't followed Regeneron, and I think it's because you see the fundamentals. They're a little different. And I'm going to compare this guy to Pfizer because Pfizer is a no-growth situation, but their margins are far better. They also produce a really high dividend, near 7%. That's a nice dividend. They can afford it too. So investors in Pfizer are being paid a very nice yield in cash, right? Or in dividends. Now, that's pretty good. And they're expanding their net profitability because even though they're not growing the top line, they're growing the bottom line, which is okay. In my book, I want businesses that are growing the top line. They're not growing the top line. They're not showing me that they're good enough. They have to show me that, hey, the products are good enough for the market to expand the usage of the product or service. More customers are coming and finding them and buying their products. They really like their products. The existing customers are buying more of the product. All those things are positive, and we have positive growth on the top line. That's what it means. When the top line doesn't grow, it means that you're not growing. And if you're not growing, maybe your competitor is growing. And that's a big threat. So Regeneron, yeah, I think 9% is adequate there. We had about 3.8 billion in cash flow. We're going to go trading 12 months. Plus growth. And I'm going to grow them at 4%. That's it. Just growing at a little higher than inflation because they're not proving to me that they're growing. And everything's growing at 4%. And when I do that, it's worth 74 billion. And their cash is a little bit more than debt. Cash is 7,470 million. Now we've got 2,710 million. The shares outstanding are wrong. So let me correct that. Shares outstanding 103. So it's discounted by 24%. Now, when we look at earnings per share, this is where analysts do most of their valuations. And again, I don't depend on these. They're supposed to do $40.28 next year. PE at 12. And that's being a little generous because they're not growing. Growth rate. You're supposed to grow their bottom line nicely. Okay. So this is just not, it's not floating my boat. I don't like non-growing companies. You're not giving me a compelling discount. I'm not feeling it. I can buy Pfizer with a better discount, better dividend rate. I can buy AbbVie at the same discount rate, and these guys have momentum. They're growing their top line. And Johnson & Johnson is priced too high. Novo Nordisk, this is probably the best discounted stock. This is growing top line, and it's discounted by 41%. It has had a big sell-off similar to the one you've seen on Regeneron. So Regeneron just doesn't do it for me. It's not compelling enough. There's too much risk for it just to be kind of a flatline kind of stock. It just doesn't do anything. It just keeps going sideways. And I don't need that in my portfolio. I need stocks that are going up or they're getting out of my portfolio, unless it's a stock that I'm expecting, hey, you know what? Like my real estate investment trust, most of my stocks are growth stocks, but I do have some stocks that are kind of like safer, kind of like just put them in the corner, let them keep going. Kroger, CTRE, and some stocks like that. Those stocks have gotten the job done. They've doubled in value every 5 years and they pay a dividend. I don't expect Regeneron's going to double in value. So those are my comments on Regeneron. I hope you found them interesting. And you asked about two really good, interesting companies. I liked Accenture more than Regeneron. So thanks for asking. And I'll keep this around a little bit in case you have any questions. So, all right. So I've got to get to the next stock. The next stock is TMDX. And this one, TMDX, Transmetics. We looked at this stock recently. And today we had Sam Fowlia. Thank you so much for the super chat. Transmetics, a commercial stage medical technology company, engages in transforming organ transplant therapy for end stage organ failure patients in the United States and internationally. The company offers organ care system, portable organ perfusion, optimization, and monitoring system. So they're a med device company. They're selling med devices to people that are really are struggling with one of their organs. Okay. Let's take a peek at their website. I knew what Regeneron did. I knew what Accenture did, but these guys, just want to make sure I can kind of get a visual on what are they doing. All right. So okay. Nice website, by the way. Looks good. So that's the machine. Look at that. So they keep these organs alive. And I guess when you're going to take an organ from somebody who's a donor and get it over to somebody who needs it, it's really important that you keep that organ alive. So I get it. It's a necessity. So let's get cracking on this. We know what the business does. So this is pharma device. I'm expecting a couple of things. Margins aren't going to be as good, but let's see how they're growing. $4.35 billion in market cap. Nice and small. Good. Revenue, $531 million. P is a little high, 63. Forward P is high, 55. You know, let's think it's priced a little too expensively. Year to date, wow, this thing's a bottle rocket. 104%. 1 year down. Whoa. This looks a lot better than this. It looks like it really went down, and then investors pick this thing up. It is a small cap, which is great. That's what small caps will do. It gives you opportunity to buy them. See how this has an upward trajectory overall, and it's offered up some really nice buy opportunities. We may have missed the boat on this one, but let's do the analysis and see what we've got. All right, looks good. Let's keep going. Wow, nice growth, 48%. And they've been growing really well. Looks like their product works. You could tell because more hospitals, surgeons are using this product, and that's where the growth is coming from. If the product didn't work, this thing wouldn't grow. They'd be like, forget it. That product's no good. This product, just high level, seems to be really good. It's working. More hospital surgeons are using this particular product. Okay, so the growth is fantastic. Gross margin 60%. Those are good margins, very good margins. The reason I expected lower margins is they're making a thing, right? You got to put in material costs. You got to put labor costs. You got costs going into that product, but in their case, I guess it's profitable enough. They're keeping really nice gross margins at 60%. Free cash flow is not good. 17. How come you're not getting more cash flow? What is the problem? So that is a little bit of a surprise. We got a $500 million business producing $17 million of free cash flow. That's not very good. Free cash flow margin, 3%. That's not good. They've been around for a while. They already have some pretty good scale. So why are we having to put so much capital back into this business? Let's take a look at their financials. And I like looking at the actual company's financials for the clarity that I need, because the stock analysis website does a nice job, but sometimes they generalize the data a little too much. Okay, so where are their filings? Let's see here. Here we go. It's financial information. Okay, so this is a statement of cash flows for 6 months. It was released, let's see, 6 months. So this is for June 30th. So this is a quarter that just ended. Very good. So this is their profit. You always start the statement of cash flows has 3 sections. The first section, along with CapEx, is what we're interested in. The first section tells us just their operations, how much cash was produced or consumed. So we start off with profit. They had this much profit come out of the business for the first 6 months, which I believe this is in millions. This is in thousands, so this would be 60 million. Okay. Depreciation is added back because it's a non-cash item. Stock-based compensation is added back. That makes sense. These are kind of like just natural things, like their accounts receivable. When it's negative, it means that they paid off their accounts receivable. No big deal. Inventory grew a little bit. Not a big deal, because at the end of the day, just their operations, they had $88.7 million produced. This is what is consuming cash, is plant, property, and equipment. This is capital expense. And they put a lot of capital back into the business. And this year, for the first 6 months, they're $52 million cash positive. But this is like, if you look at a Meta, if you look at a Google Alphabet, this is like nothing. This is like zero. If you look at a utility company, this number ends up being as much as the cash from operations or higher, which is why I don't like utilities. This one is a kind of a high number. This consumes a lot of the cash. Okay, so that was the answer to my question, which is, where is the cash going? It's getting put back into the business. It's just a type of business where you have to put back a bunch of capital, probably in the factory that's making these devices. Going back to their financials, I want to take a peek at something. And I'm looking at the wrong company. So here's the financials. I want to look at something. I want to look at the quarterly. Quarter by quarter. So this is, we just saw that number, if you recall, and it's not $82 million of free cash flow. We saw that it was 82 million minus 32 million. So it's 50 million. So our friends at Stock Analysis don't have this data right. Okay. All right. And I was looking at a 6-month number. So this number was this number. Okay. They do have it right. Okay. They do have it right because I was looking at a 6-month number. Now I catch myself. Okay. So for the last 4 quarters, it's just not a lot of cash. They're not producing a lot of cash. I mean, I'm trying to figure out, is it a temporary thing or is it just a low cash producing business? See, they've never produced positive cash up until this year in the trailing 12 months. So this one's going to be a less desirable business for me because you could probably get a pretty good valuation based on earnings per share. But so Armando Marquez, they invested in airline to transport organs. Okay. That's where they have low cash flow. Yeah, airlines, not a great business. So they invested in an airline, huh? Okay, so all right, so I'm not going to be able to value them based on cash flow because that would get a super low valuation. We're going to look at earnings per share, but I would tell you that I don't like what I'm seeing. And the reason for it is you have a lot of choices in healthcare. Right now, healthcare is so discounted. You can find, and I'm not exaggerating, you can find 50 companies that are discounted really nice. You can find 50, 20 companies that are growing at these rates that are around this revenue size. So it's not a very rare company to see a company that's growing at this rate. It's one thing to grow your top line, but if you can grow it really well like this and have high margins and have high free cash flow and have a great balance sheet, boom, now you have a very desirable business. These guys don't check all those boxes. They are missing the cash flow. The cash flow is critical to me. I wouldn't invest in this stock, but let's keep going because you paid for a valuation and that's what I'm going to deliver. So let's crank open a valuation. Let's take a look at what analysts are saying about earnings per share. Analysts say it's a little bit expensive. price targets of 150 to 75. That's not good. And the earnings per share is supposed to be $2.57. That's using a forward PE of 49. Oof, that's a high PE. Spoiler alert, I'm probably not going to get to this stock price. Let's keep going. All right. See you, Mike. Good seeing you on the chat. All right. So 257. All right. So we're going to kind of just stay in this zone because we are dealing with another healthcare. Actually, you know what? I'm going to take that back. We're going to go to United Therapeutics because I want to tell you about United Therapeutics once I get done with this particular stock. Okay, so we have TMDX, and this is Transmetics. So I'm going to leave that discount rate at 9%. They don't have any cash flow, so we're just going to disregard this. I can't drive cash flow. I think their free cash flow for the first 6 months was 32. So if I went to 64, and they are growing quickly. So let me just kind of give this my best attempt. Let's say they grew that by 10%. And they have $400 million in cash, and they have $518 million in debt. They have a tiny bit of debt. I don't think it's a big concern. I would just watch it because if debt is climbing, that's a bad thing. And we have shares outstanding of 34. So yeah, it's highly priced at a big premium because even going with these numbers, I'm kind of being generous. They've been proven that they can't generate free cash, but I'm giving them the benefit of the doubt and saying going forward, they are going to generate cash. And if I give them that big kind of upside potential, that's what they end up with. This was 257 in earnings per share. For this business, I'm not going above 24. Were they growing that earnings per share? So they were. So growing by like 15%. So yeah, this one is priced way too high. And it just has a lot of, when you can't generate cash, it just shows that the business has some undesirable cost elements in the business. I'd rather have a business like United Therapeutics, which has some connection to these guys do human to human medical transplants, and they help in that process. United Therapeutics has drugs in commercial stage that are making money and generating cash. They also have a new line of business where they're doing organ xenology, which is they grow organs in a lab and then they transplant those lab grown organs into a human being. It kind of makes my head explode to think the science is there, but these guys are doing it. And these are really smart scientists. If you look at their track record, super impressive. This business, in my opinion, is discounted by 42%. These guys are growing. They crank out free cash. Their scientists are brilliant. They have very high free cash flows. So it's all about shopping around for the best investing idea. And in this industry, healthcare, there's a lot of really good opportunities. It's not like, technology where, geez, man, everything's priced super high. It's really hard to find a great business that's discounted. In healthcare, it's hard to not find, or it's easy to find discounted businesses because the industry just is been sold off so harshly. So Transmetics, not my cup of tea. It just doesn't value. Cash flows aren't high enough. Earnings per share isn't high enough. And I'd rather bet on something like United Therapeutics, which I am a stockholder in. If they pull off this grown in a lab organ business and they start growing kidneys, they start growing organs, and then they transplant them over to a human being, it's just going to be, first, it's going to help a lot of people, but it's going to be worth so much money. Because, who wouldn't pay for an organ when they need it? Or you have a loved one that needs one. Of course you would pay for that. And I'm excited about that business. I hope they pull it off. If they do, that's going to be a 10 bagger for me. And so far, so good on United Therapeutics. They're buying back $1 billion of shares because they have so much cash, because they produce so much cash. They're buying back shares big time. So thanks for asking. You wanted to deep dive, Sam, and I gave you my best, man. I dug deep. I want to reveal if you've got a stock that has terrific fundamentals and has a great value. I want to reveal that. Or I want to reveal we don't have that. We have a business that is not measuring up to its competition for our capital. We worked too hard for our capital to put it in mediocre stocks or stocks that are going to, burn our capital, burn our cash. No, we want our cash to grow. We want it to go up in appreciation. So thanks so much. It's great to see your name. Thank you so much for the super chat. Paul, good to see you, man. So they reported Q2 RIGL on the list, sir. Okay, so we got Accenture. We banged that one out. Regeneron banged it out. TMDX just finished it. We got to hit Applied Materials. We got RIGL on the board. Michael Anthony. Thanks for the comments. Way to mix it up in there. Have a good night, Shadow Guy. You probably left already. Great to see your name. And then Tiki Taxes, Regeneron, please. So I covered Regeneron earlier. And then Amandio Marquez, thanks so much for sponsoring 2 deep dives and for the comments. Forensic accounting. When I was in college, I was an accounting major, business major, and the FBI came on campus, and they were actually recruiting accountants because they wanted accountants so that you could, when you went after white collar crime, you had people that could read through financials. I thought it would have been a cool job, but then I got a different job that was even better. So I went with the better job. All right. So it looks like we've got that. Michael Anthony, thanks for putting it out there. Good comments. I'm catching up on comments, everybody. Bear with me. I just Want to make sure I didn't miss something. And I don't think I missed anything, but I'm reading some interesting comments. So Arthur Anderson did books for WorldCom as well. WorldCom was another company that imploded. Little J, we're going to do Applied Materials. Hang in there. We got a lot of people on the stream today. And I think I've caught up. I think I caught up, everybody. All right, cool. Let's get back into it. Jeff, good to see you. Wait for NVO to start moving. Yeah, I'm thinking, NVO might be a little premature, but United Healthcare is off to the races. And I totally believe that. We covered United Healthcare early in the stream if you want to watch the recording. All right, let's get into Applied Materials. Applied Materials woke up. It woke up with a bad hangover. It was like, oh no. I knew I shouldn't have eaten that week old sushi that was in the back of the fridge. It's not really agreeing with my stomach. I've been up all night throwing up. That's what Applied Materials felt like. Down 14%. These guys are part of the semiconductor industry. And semiconductor is supposed to be flourishing. But let's take a close look and see, well, maybe parts of semiconductor are flourishing and some parts are not. Applied Materials, so they do manufacturing equipment, software, displays, and related industries supporting semiconductor. So they're not making semiconductor chips. They're selling them the products and materials and softwares they need to manufacture those chips. $229 billion market cap, revenue $28.6 billion. Low PE and forward PE looks pretty decent. Little dividend at 1.14. Analysts think it is discounted. Year to date, this one is just even, down a little bit. 1 year, this one's losing money, 20%. How are you losing money when you're in the semiconductor space? How is that possible? But here it is. These are the facts. Over the 5 year, you did fine with this one. You doubled your money. Mission accomplished. If you bought at the right time, you're doing okay. Doing better than okay. This is a very good rate of return. When we look at their growth, they are growing, although they're just kind of crawling. They're just growing a little bit. And the growth in the most recent quarter is pretty decent. This company did guide that they're not sure how good the semiconductor market's going to be. They're not overly confident, and that's what torpedoed their stock. Is the guidance was not reassuring, it wasn't confident. And they may be concerned that, hey, semiconductor is not booming for us. Their cash flow is not growing. It had a nice growth from 2022 to 2023. You saw that the 5 year chart looked great. Well, maybe it's because the investors saw that they were going to go from 2.8 billion up to 7.4. So you see how the stock doubled in value. But now you're seeing this 5.8 big drop from in the trailing 12 months from 7.4. So that's when investors are probably restating their valuation of the company, and the stock price is dropping because the value is perceived to be lower. The gross margins are not superb. 48.5 is good, but it's not great. Nvidia's up at 85%. So this is an okay margin business with free cash flows that are dropping, and it's a slow grower. So not a lot of excitement with a management team that's saying we may not have very good months ahead or quarters ahead. It may be tough. We may be seeing a contraction in the business. When we look at what analysts are saying, we have some analysts that have price targets at 230, lowest price target 165. That's not too bad. Not a lot of downside risk. What they're looking at is they're saying that, hey, this business is going to continue to grow. Single digit, middle single digits. Not too bad. And the earnings per share will also grow. So that looks pretty good. All right. So what torpedoed the stock was the guidance. The growth is pretty decent. And when we look at the cash flows, these guys are worth 100, 130 billion minus debt. And they have a little more cash and debt, so that's not going to be a problem. Yeah, they're fairly priced. They're fairly priced and they pay a tiny dividend. I don't like the risk because semiconductor has been booming, and you think about how much can businesses continue to spend on semiconductors before they need to pull back and say, hey, enough's enough. We can't put more money in the data center. I think we're approaching that point. I don't know if we're a quarter away or a year away, but I just don't see that the next 3 years are going to continue to boom the way they have been for semiconductor. Having said that, that's probably what Applied Materials is concerned with and is guiding the investors. So this is a fairly priced stock that the management team is telling you there's risk ahead. So it is not something I would touch for me. They're not giving me a huge discount. Best case, the stock price is going to be worth the same in like 2-3 years. Well, forget that. I'd rather stick my money in bonds, earn a little bit of yield, and not be exposed to stock risk. Stock risk is way higher than bond risk. So Applied Materials is a total pass. I think there's nothing there for me. And I think a lot of investors are feeling that way, and that's why the stock sold off by 14%. So that is Applied Materials. Paul, you want to take a look at RIGL. This is Rigo Pharma. This was up 4.28%. 1 year, it's only up 230%. Holy smokes. Up 134%. Jeez. Incredible. This is a biotech company. So they have therapies to enhance the lives of patients with hematologic disorders and cancer. Okay. Small cap, 708 million. Revenue, 267. We've looked at this stock before. So we're going to update the valuation on it. And I think earlier in the stream, I said in healthcare, we can find stocks that have excitement. And this is an example of it. When we look at the growth, holy smokes, 105% growth. Wow. Just taking that in, that's really, really impressive. 176% in the most recent quarter. They announced this quarter on August 5th. So the stock took off, right? August 5th. Yep. This is when the stock just took off. Investors, man, why didn't I read this earnings? I missed a pretty good move there. All right. Well, that's why we got to pay it. That's why I got to pay attention. This is a phenomenal stock. And Paul, is this one you own? Holy smokes, man. This thing took off. All right. RIGL. We have a valuation on this puppy. They have really good fundamentals. I went with a higher discount rate since they're little. Let's take a look at their free cash flows that they just announced. Yeah, their free cash flow doubled in the trailing 12 months, which only includes half of the current year. So the growth in cash flow is just really, really fast. Okay. So quarterly. So this is what makes these businesses hard to forecast. So when we go to the quarterly, when we looked at this stock, free cash flow, they put up like a negative free cash flow in the quarter that we looked at. And it's like, oh man, how come you don't have consistent free cash, right? You're making very good margins, gross margins of 75, 80, 75, 95. These are just terrific numbers. So this is what made the forecasting harder. Now they put up a positive number, which is really good. And the trailing 4 quarters, this adds up to, 35, 36, 66, 67 billion. That's a really nice number. So the trailing 12 months look good. You see how small businesses that don't have a lot of data behind them, they're harder to forecast because you get, a number that could surprise you, and you don't want to be surprised to the downside. So you're protecting yourself by going conservative. I went with 31.44. My forecast was too low, but that's how my logic was put together on this. They're growing tremendously. So here, like we did earlier, I'm going to go with 3 growth rates. Growth rate for year 1 and 2. And then years 3 and 4. And this year, these 2 years, I'm going to grow by 50%. And then these, I'm going to grow by 30%. And this is going to grow by 5. So this is going to grow by 50%. And we'll change this to the field above it. This one's fine. So this has a bigger valuation now. Okay, so, and we have balance sheet, 108 million in cash and 61 million in debt. Shares outstanding 17.94. They looked it up correctly. So you have a highly discounted stock. The growth rate is really going to create cash because the gross margins are really high. It's going to start cranking out cash. This stock's looking good. During earnings, there's so many earnings coming out that I just didn't take the time to look at this stock. If I would have looked at the earnings, I would have probably bought this stock. Looking back, kind of lesson learned. And this was a small cap, so I didn't have time to look at it, but we're looking at it now. Earnings per share for the next year is 196. And this is a high growth stock, so we'll go to 36, and it's growing really fast. So I'm going to grow it by 40%. So this is the valuation on this looks terrific. And as crazy as it sounds, this is a buy. Even though it's really gone up a lot, it's a buy for me. Even though this thing has like been a rocket ship, it's a buy. The ship has begun to sail, but this business, if it's real, it's worth a lot more. So I'm going to keep a close eye on this and see if it'd be a good entry point next week to get into this stock, and we'll go from there. So RIGL. All right. Well, thanks for asking, Paul. Man, I wish we would have looked at that 2 weeks ago. We could have doubled our money over 2 weeks. But, you know, that's investing for you. Nice job on buying RIGL, sir. Nice job. Good job on that one. All right, Jeff. So you got, great moves on United Healthcare. United Healthcare, we went over it earlier. Let me show you where I am with my evaluation on United Healthcare. Here's United Healthcare. It's still discounted by 33%. I have a price target of $494, and I think they're going to get to $600. I think their business is going to keep getting better and better, and the story is going to get better. Warren Buffett buying into it is terrific news. The stock is headed in the right direction. I don't think anything's going to stop it. It's like it's had just bad news after bad news. And you see how in the last month it's picked itself up, and it's up 27.8% over in the month of August. And I think it's going to go back to $600 a share. That's where it was. Is that the all-time high? Yeah, it's the all-time high. So it's going to get back there, and it's probably going to go higher over the next couple of years. But this one here, I'm really glad that they're back going in the right direction, and really good, solid investors are in United Health. The stock's selling a little higher in the after hours, but it's super early. It's just Friday night. We got the whole weekend to get through. We'll see where it goes. All right. Well, that was an awesome stream, everybody. That was a quick 2 hours. Jeez. You guys made it fun. Went by quickly. I really appreciate all you members of the channel. Thank you so much for your continued support. Sam, thanks so much for the super chat. Amandio, thank you so much for your super chat. I really appreciate it. Thank you. I hope you found my analysis of Accenture, Regeneron interesting. And Sam, I hope you found my analysis of TMDX interesting as well. Thanks so much. Please come back. It'd be great to have you again. I'd like to invite all of you guys to become members of the channel. It is easy to get more information. Visit the home screen of my channel. Look for a join button toward the bottom of the screen, and you can see the 3 different options to become a member. I think it's worth it. On live streams, your name appears different. And if you have a stock that you want me to look at, it's included with your membership, and I'll take a look at it. If you are interested in my analysis, I publish it out to the members, and you could search my valuations at any time, 24/7. You also get a hold of that valuation template that I use, a working template, so you can work with it. And you can also attend the member calls. We have 3 a week. You'll be invited to the Discord. I think it's really worth it. We have a lot of members now, and I think the conversation and the number of minds that are working together is really, really something. We have a lot of good opinions on stocks. We have doctors in the community. We have a lot of tech people that know technology. Let's keep it growing so we could just keep getting better. And we have really good insight, really good points of view on stocks. I really encourage you to take a look. It'd be great to have all of you join, especially some of the names that I've seen on the chat for a while. You guys have really good ideas, and it'd be great to get you on calls or in the Discord. So everybody, have a really nice weekend. Thanks for joining the live stream. Thanks for all your support. The live streams have been awesome this week, and we've had a lot of new members. Thank you for joining, and I wish you a really nice weekend. Take care, everyone.